The S&P 500 and the ASX are hitting all-time highs, and that makes people nervous. Is this the right time to buy? Are stocks overvalued, or should you just wait to buy the dip? The truth is, waiting for the perfect time to invest could be a big mistake. And that's going to be the topic of this video. Welcome to the channel. I'm Tomo and I explain difficult financial concepts in an easy to understand format. The markets are looking quite expensive right now, so let's take a look at some of the numbers. Now, a common way of valuing companies and a common way of valuing markets to see if they're expensive or cheap, it's what's called a PE ratio, or a price to earnings ratio. What that means simply is how much are you willing to pay for the profits of the company. So as an example, if a company was trading at $100 per share on the stock market, and that company had $10 of profits, and you bought the stock, that would be a PE ratio of 10. It would take you roughly 10 years to recover your initial $100 investment on the presumption that that company would make $10 per year. Or another way of thinking about it is your investment would yield a return of roughly 10% per year. So the current PE ratio of the S&P 500 is around 30, with the historical average sitting around the 17 to 18 mark. And in Australia, the ASX has a current PE ratio of 22, with a historical average of 14. So these current PE ratios, representing the price, are much higher than the historical averages. Now, another valuation metric used is called the Buffett Indicator, after the great Warren Buffett. What this does is compare the total valuation of the stock market, so the total valuation of all listed companies, to the GDP of the United States, which is all the goods and all the services produced by all the companies, regardless if they are listed on the stock market or not. When this metric is around 100%, this is considered to be a bit of a pricey stock market. The Buffett Indicator at the moment is sitting at 200%, meaning the valuation of the listed companies on the stock market are twice as large as all the goods and all the services performed by all the companies in the United States. And this large increase in valuations has been fueled by tech stocks, namely the Magnificent Seven. In 2015, the Magnificent Seven made up around 12% of the total S&P 500. Now, they make up 34% of the index. And the valuation of these tech stocks are absolutely massive. The PE ratio of Nvidia is around 50 at the moment. Of Microsoft, it's 33, and of Apple, it's 38. Sound familiar, anyone? Is this starting to look like the dot-com bubble in the late 2000s, which was largely driven by speculation on internet companies, even if those companies did not have any profits or earnings?
Netscape initial public offering, or IPO. The company was less than 18 months old, had little revenue, and no profits.
Nobody expects what happens in Netscape. It's the first big pop stock. It was just, whoa.
This is what makes it more difficult this time around. Although those tech companies have insane valuations, a lot of them actually have really reputable earnings. And with the way that technology and AI is trending, the earnings of these companies is very possible to only increase into the future. So we could possibly see a scenario where instead of, say, the S&P 500 providing good diversification, being fairly spread out in terms of the companies you can invest in, fairly diluted, we could possibly see a scenario where that diversification reduces and reduces as the valuations and market shares of these tech companies grow bigger and bigger and become larger parts of the index as a whole. And markets can stay expensive for years on end and keep going higher and higher and higher. So is this a bubble, or is this just the new normal? Let's take a look at what would have happened had you invested at some of the worst times in history. One of the number one fears that actually I have as an investor is, what if I buy at the wrong time? What if I buy just before a crash? So let's say you had invested $10,000 in the S&P 500 on the Friday before the global financial crisis crash in 2008. Had you have done that in 6 months' time, your investment would have halved in value. Pretty brutal. But here's the crazy part. Had you have held on and not panic sold, then by 2020, which is 12 years later, then your investment would have doubled in value. And had you reinvested any dividends along the way, your investment would have almost tripled in value. Same story in Australia. The market dropped 50% during the global financial crisis. So had you have panic sold, you would have taken a massive loss. But had you have stayed invested and reinvested any dividends, then you would have broke even in 2013. And by 2025, you would have doubled your money. So the lesson here is, even if you had invested at some of the worst possible times, with a long-term time horizon, it is better than not have investing at all. Doubling your money is better than not doubling your money. So why do so many people still try and time the stock market? Even Warren Buffett is famously saying for having no idea which direction the stock market is moving.
Charlie and I haven't the faintest idea where the stock market is going to go next week, next month, or next year. We never talk about it. It never comes up. Our directors will tell you that they've never been to a directors meeting where the subject of the direction of the stock market is. We are not in that business. We don't know how to be in that business.
And it's a well-reported statistic that over the last 15 years, about 80% of professional investors have been unable to beat the S&P 500 index. So if they can't time the market, and if Warren Buffett can't time the market, then why should you and I try and time the market? Maybe asking the question if the market is too expensive at the moment is the wrong question to ask. One strategy that you could possibly adopt is something called dollar cost averaging. And what a dollar cost averaging approach is deciding on a sum of money that you can invest at regular intervals. And I would normally recommend aligning this with your pay cycle. So it could be weekly, could be monthly, that sort of thing. And by buying stocks at a consistent basis at regular intervals, what this means is that when the stock market is really expensive, perhaps like it is now, you naturally buy fewer stocks because you can only afford fewer stocks. And then if the stock market declines or it crashes a little bit, because you're buying stocks at regular intervals, you're now buying more stocks with your money because the stock prices have become cheaper and you're able to buy more stocks with your regular amount invested. And over a long time horizon, you achieve about an average price for the stocks. It takes out a little bit of that volatility. It smooths things out a little bit and takes the guesswork out of timing the market. So you become less worried if the market's expensive or not and more focused on investing your sum of money at regular intervals. So is the market expensive right now? Yeah, it probably is. Could the market crash? Absolutely, but we have no idea when. But history shows that consistent investing, even through crashes, is how you build wealth. The real risk is not buying at the wrong time. The real risk is not buying at all. Now, if you found this video helpful, all I'd ask is that you hit that like button, it's free to do so, and consider subscribing to the channel. And maybe share this with someone who's waiting for that right time to invest, because that time may never come. Now, please keep in mind, I'm not a licensed financial advisor. This video is for educational purposes only, based on publicly available information. See you in the next video.